Hi everyone, I hope you're ready for another tax study session. I'm going to be your virtual companion in studying the methods of accounting. But before we start, here is our student's guide to learning from home. Set up your study space. Find an area in your house where you can sit comfortably and focus. Make it separate to your relaxation space, ideally away from a TV screen or other distractions. Take down notes. Stop in a webinar zoning out. Taking down notes keeps your mind engaged. Plan your day ahead. If you have one, follow the schedule provided by your school. If you just have a list of things to study, break it down into small tasks and plan to do the hardest ones when you have the most energy. Lesson distractions. Furnish your imagination and picture that you're at school and not at home. Lock your phone away if you need to. Don't be afraid to ask your parents to intervene. And subscribe to productivity apps as well. These are great companions so you can focus 100%. Change it up. You probably have a schedule for your lessons, but if things are becoming difficult to focus on, take a 5-minute break and come back to it. Just let your teacher know. Be kind to your mind if you need a break from a consistent schedule. Now, to our discussion of methods of accounting. Accounting methods for tax purposes comprise a set of rules for determining how to report income and deductions. As a general rule, the law does not provide for a specific method of accounting to be employed by the taxpayer. The law only authorizes the CIR to employ a particular method of accounting of income where the taxpayer does not employ a method for computing income or the taxpayer's method for accounting does not clearly reflect the income. So here are the principal accounting methods for recognition of income. We have the accrual method, cash method, accounting for long-term contracts, and installment basis. First is the accrual method. Under the accrual method, income is recognized on the period it is earned and regardless of whether it has been received or not. In the same manner, expenses are accounted for in the period they are incurred and not in the period they are paid. Amounts of income accrue when the right to receive them become fixed, when there is a created enforceable liability. Similarly, liabilities are accrued when fixed and determinable in amount without regard to indeterminacy merely of time of payment. The accrual of income and expenses is permitted when the all events test has been met. These tests requires fixing of a right to income or liability to pay and availability of the reasonable accurate determination of such income or liability. The test does not demand the amount of such income or liability be known absolutely, only that the taxpayer has at his disposal the information necessary to compute the amount with reasonable accuracy. The all events test is satisfied where computation remains uncertain. If its basis is unchangeable, the test is satisfied where a computation may be unknown, but is not as much as unknowable within the taxable year. The amount of liability does not have to be determined exactly. It must be determined with reasonable accuracy, which implies something less than an exact or completely accurate amount. The propriety of an accrual must be judged by the fact that a taxpayer knew or could reasonably be expected to have known at the closing of its books for the taxable year. Accrual method of accounting presents largely a question of fact, such that the taxpayer bears the burden of proof of establishing the accrual of an item of income or deduction. Example: for an income transaction using the accrual method, You would record the income when the work is complete or the product has been received. That is, you have earned the payment. Income to you is recorded when you send out the bill, even though you have not yet been paid. The liability is recorded when you receive the bill, even though you have not been paid. On the other hand, for an expense transaction, when you receive a bill for an expense, it's considered a liability. So you can deduct it for that year even if you haven't paid the bill yet. Prepaid expenses are a special case. In general, you can't deduct expenses in advance. For example, if you paid for internet service for 12 months, you can only deduct, for example, if you paid for an internet service for 5 years, you can only deduct the cost of 1 month on your business tax return for the year. Or if you paid for your rent for 5 years, you can only deduct the cost of 1 year on your business tax return for the year. Next is the cash method. In cash method, income is recognized only upon the actual or constructive receipt of cash payments or property, but no deductions are allowed from the cash income unless actually disbursed or paid through an actual or constructive payment in cash or property. Stated otherwise, income is earned, when cash is collected or received, and expense is incurred when cash is disbursed or paid. It is also referred to as the cash receipts and disbursements method because both the receipt and disbursement is considered. Thus, income is recognized only upon actual receipt of the cash payment, but no deductions are allowed from the cash income unless actually disbursed through an actual payment in cash. So we have here an example. For an example, an income transaction, if you perform a service and bill a client, you record the income for cash accounting purposes only when you have received the payment for that services. So if you send out an invoice on August 12 and you don't receive payment until September 1, you record the payment on September 1. So put that into writing. You send out an invoice on August 12. This would be your invoice date. And then, you don't receive the payment until, so let's put it here, payment date is September 1. Okay. You will not, under the cash accounting, you will not record the payment until you receive the payment. So, it would be on September 1. Okay. So, next is for an expense transaction. For an expense transaction, you might receive a bill for phone service, but in cash accounting, you don't record the expense until you have actually paid the bill. So, for example, you have received the bill was received on August 15. And then you paid the bill on September 1. So, under the cash accounting, you will record it in the books on September 1 when the bill was paid. Okay? So, now let's move to another method of accounting, which is the accounting for long-term contracts. So, before that, let us define what are construction contracts. A construction contract is a contract specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology or function, or their ultimate purpose or use. In Philippine Accounting Standard number 11, it requires the treatment of a contract to last for a period of more than 1 year. The main point is that the contract activity starts in one financial period and ends in another, thus creating the problem to which two or more period contract income and cost should be allocated. So, income from long-term contracts shall be reported for tax purposes in the manner as provided in this section, the section 48 of the NIRC, or the National Internal Revenue Code. So, as used herein, the term long-term contracts means building, installation, or construction contracts covering in excess of 1 year. Persons whose gross income is derived in whole or in part from such contracts shall report such income upon the percentage of completion. Okay. Based on the percentage of completion. Now, the return should be accompanied by a return certificate of architects or engineers showing the percentage of completion during the taxable year of the entire work performed under the contract. There should be deducted from such gross income all expenditures made during the taxable year on account of the contract. Account being taken of the material and supplies on hand at the beginning and end of the taxable period for use in connection with the work under the contract, but not yet so applied. So actually, this is one of the topics from Practical Accounting 2 or Advanced Accounting 2 subjects for accountancy students. So let us have here the percentage of completion method. Under the percentage of completion method, a schedule is made of the contracts in process showing the total cost incurred as of the end of a given period, the estimated gross profit recognized based on the degree of completion, and the total billings rendered on each individual contract. So to give you an idea of how we compute revenue based on percentage of completion, here is a sample problem. Okay. Naning Kamot Construction entered into a contract to construct a floating bridge across a lake. The contract price for the bridge is 7.5 million. During 2019, costs of 1.8 million were incurred, which represents 30% of the total expected costs. Let's compute the income to be recognized during the year. For the computation, we have the given figures or the given items. We have contract price for the bridge, which is 7.5, the cost incurred in 2019 of 1.8, and percentage of completion of 30%. The cost of long-term construction contract is 1.8, which is already given. Construction in progress is computed based on the difference between our contract price, 7.5, and the total, the construction progress is computed based on the total cost, okay, which is 1.8 divided by 30%. So you will get the cost of the contract, the total cost. Okay, let's write it down. Total cost of the contract, which is computed based on the cost, that's 1.8 million divided by the 30%. So we gross up, that is 6 million. So 7.5 million less the 6 million, the total cost of contract, we will have 1.5 million as the expected profit. Okay, so we will get the realized profit, which is 30% based on percentage of completion. So you will have 1.5 million multiplied by 30%, or 450,000 as realized profit. So for the year, the revenue from long-term contract is at 2.25 million. Okay? So now, So here, if cost incurred plus recognized profits exceed the related billings on a contract, this net figure is considered as a current asset. This treatment shows that the contractor has not fully billed the customer for work performed to date and has a claim against the customer for that portion of work completed but not yet billed. However, if billings on a contract plus its recognized profit is less than the related billings, the net figure is considered as a current liability, which means that the contractor has overbilled the customer for work done to date and must complete the work represented by the excess billings. Okay. Last on the list for the discussion in this video is on installment basis. So let us define an installment sale. An installment sale is a contract whereby a buyer makes a series of payments over an extended period of time in exchange for property acquired. So consumer goods with relatively high selling price, such as electrical appliances, jewelry, automobiles, and recreational equipment, are commonly sold in this manner. The same is true with other types of property, such as developed real estate or land. When there is uncertainty as to the collectibility of the sales price, generally accepted accounting principles require that revenue recognition should await the actual receipt of the cash. So take note, Section 49 of the Tax Code provides that for sales of dealers in personal property, sales of realty, and casual sales of personality, and sales of real property considered as capital assets by individuals are computed based on installment basis. So any of the foregoing methods may be employed by any taxpayer. Okay, you have the accrual, cash, accounting, installment basis, so long as it reflects its income properly and such method is used regularly. So the peculiarities of the business or occupation engaged in by a taxpayer would largely determine how it would report income and expenses in its accounting books or records. The NIRC does not prescribe a uniform or even specific method of accounting. So other methods approved by the CIR, even when not expressly mentioned in the National Internal Revenue Code, may be adopted if such method would enable the taxpayer to properly reflect its income. So Section 43 of the National Internal Revenue Code or the Tax Code authorizes the CIR to allow the use of a method of accounting then its opinion would clearly reflect the income of the taxpayer. So an example of such method not expressly mentioned but duly approved by the CIR is the crop method of accounting. So crop method of accounting. So here, it is a method applicable only to farmers engaged in the production of crops which take more than a year from the time of planting to the process of gathering and disposal. So, when expenses paid or incurred are deductible in the year, the gross income from the sale of the crops are realized. So, the crop method recognizes that the harvesting and selling of crops do not fall within the same year that they are planted or grown. This method is especially relevant to farmers or those engaged in the business of producing crops who pursuant to RAM number 2-95 would then be able to compute their taxable income on the basis of their crop year. On when to recognize expenses and deductions against income, the governing rule is found in the second sentence of subsection F cited above. The rule enjoins the recognition of the expense or the deduction of the cost of crop production in the year that the crops are sold or when income is realized. That would be all for this video, guys. Please do share and subscribe to my channel for more tax lessons. And this is your virtual mentor signing off. Remember, don't just wait to be an inspiration, but be the inspiration. Keep safe, everyone. Bye.